Hey, it's Tom here and welcome back to the channel. So I am fresh off watching the 2021 Berkshire Hathaway annual meeting live, and this video is going to be a summary of some of my personal highlights from that particular meeting. Now, I'm watching the meeting from here in New Zealand, so it was a pretty early start. I think I was up at 4:30 a.m. this morning to watch the Berkshire meeting live, but certainly worth the effort, and like any good millennial, I was sitting in bed with a coffee and some avocado toast to watch Warren Buffett. So let's get straight into it. These are going to be my personal highlights from the 2021 Berkshire annual meeting. Be sure to hit like and also subscribe to the channel if you haven't already, but without further ado, let's get straight into it. So the vast majority of the meeting, as per usual for these Berkshire Hathaway shareholder meetings, was basically a Q&A session. So again, due to COVID and so on, they really didn't have their big in-person shareholder meeting expo like they usually do. So pretty much all of the questions came via Becky Quick from CNBC. So any shareholders or people that wanted to ask questions could send those into Becky Quick, and that's kind of where all the questions came from for Warren and Charlie, and also Greg Abel and Ajit Jain, and a couple of the Berkshire Hathaway managers were on the panel this year as well. But before they got into the Q&A session, Warren Buffett did make some opening remarks. Firstly, he actually put up some stats for how Berkshire Hathaway has actually performed through the first quarter of 2021, their sort of first quarter operating results, which have just come out. And the results were really good. So operating earnings for the business came in at a little over $7 billion versus only $5.87 billion in the first quarter last year. So pretty spectacular quarter for Berkshire Hathaway when you compare to where they were at the same time in 2020. Granted, that was right in the middle of lockdowns, or at least had a little bit of that kind of built into the results last year. So we're probably comparing against a relatively low base, but nonetheless, Berkshire Hathaway is certainly firing on all cylinders right now. And as he has done for the past couple of years now, Warren Buffett also sort of told investors kind of not to pay too much attention to the absolute earnings number that comes through for Berkshire Hathaway. One of the things that happens for Berkshire now, since some accounting rule changes a couple of years ago, is that they also have to report any unrealized gains or losses from just their stock market holdings as earnings. So what you'll see is essentially anytime the stock market goes up a lot, the earnings look really, really good, and anytime the stock market goes down a lot, like it did last March, the earnings look really, really bad. So if you normalize for those things, Berkshire is certainly firing on all cylinders, like I say. But if you just look at a simple earnings number for Berkshire Hathaway, it can be quite misleading, particularly in the shorter term. And the second part of Warren Buffett's opening remarks I found really interesting. So basically he wanted to give some bits of advice to a lot of the newer investors that are just entering into the stock market. 2020 and 2021 so far has been sort of a time period where there are a lot of newer investors. We've seen the rise of apps like Robinhood and so on, really making access to the stock market and investments really, really simple. And Warren Buffett wanted to basically go through a couple of things to try and get across the point that basically picking individual companies and even picking industries is not as easy as it may seem on the surface. So the first thing he did, and I'll put up the screenshots and the slides that Warren Buffett actually used just here, is he put up basically the largest 20 companies in the world right now by market cap. So in that top 20, you'll see a lot of businesses that you will recognize immediately. So things like Apple, Saudi Aramco, Microsoft, Amazon, long list of companies there that you probably recognize pretty much immediately. And Warren Buffett basically asked the question, you know, if you think for a second about what those companies might look like in 30 years' time, how many of those companies do you think will still be on that list in 30 years? And he then went back and put up a slide of, again, the largest 20 companies by market cap for 30 years previous to today, so back in the 1980s. You'll see the exact dates up on the screen here. And basically what you'll see is there is literally zero overlap between the largest 20 companies 30 years ago and the largest 20 companies today. Not a single one of those companies appears in both of those lists, which is pretty remarkable. And you'll also notice that 30 years ago, a lot of the largest companies were actually in Japan. They'd gone through a massive bull market, actually got into quite a significant stock market bubble. And it just really goes to show that trying to pick individual companies that are going to persist for a long period of time is a really tricky business. Now, he's not saying that the top 20 companies today won't, some of them won't be in the top 20 still in 30 years. He thinks that there's a good chance some of them will be there and there'll be a lot of American companies, but it's really not a simple exercise trying to pick out individual businesses that can perform for a very long period of time. The other thing that Buffett talked through was actually giving some examples of bets on industries that a lot of people are making. So there's a lot of new high-flying industries out there at the moment. Things like electric vehicles would be a pretty good example of that. And Warren Buffett basically said that, if you had the foresight 100 years ago to figure out this new, really fast-growing industry like automobiles, back in the early 1900s, in the early 20th century, if you had made a basket bet on a lot of those businesses, even though automotives as a whole did really, really well, you probably actually wouldn't have had the greatest results as an investor. So he went back and he wanted to look up all of the car companies that started with the letter M, just to pick out kind of a group of companies and just to show how many were around at that time, how many new startups were happening in the early 20th century. And basically what he found is that there were too many companies starting with M to put on one page, so he had to narrow it down to car companies starting with MA. So back at that time, when that was sort of the hot industry of the day, there were around 2,000 automobile companies, and that has narrowed down to, back in 2008, there were only 3 companies left, and 2 of them went bankrupt in 2008. So even if you had all this foresight to recognize that the automotive industry is going to grow really, really fast, and everyone's going to have multiple vehicles and all this sort of stuff, it still would have been really, really tough to pick the individual players that would have done well and sort of won that game. So from there, it was Q&A time, and the Q&A session covered a massively wide range of topics. So in no particular order, I'm basically going to go through some of the questions and answers that I noted down that I thought were sort of most interesting. So let's just start from the beginning. So the first thing was actually around airlines. So if we go back 12 months, Warren Buffett had actually just sold out of a lot of his airline stocks. He was basically invested in the basket of the 4 large airlines over in the US, and he'd sold out of them completely back in early 2020. And Warren Buffett actually gave a reason for doing that I hadn't really actually personally thought about before, and that was basically that Berkshire Hathaway had the mindset of basically not wanting to get bailed out by the government. So Berkshire Hathaway had about a 10% holding in a lot of those airline stocks, and he thought it would have frankly been a really bad look for some of those airlines to have a very, very rich shareholder in Berkshire Hathaway accepting government money. And that was one of the core reasons, aside from the investment case itself kind of falling over due to the pandemic, that was one of the reasons that he actually sold out of the airline. So that was something that was interesting. The other thing was around cash. So Berkshire Hathaway's very large cash position is always in the media, and Warren Buffett basically gave us a bit of color on how he kind of thinks about Berkshire Hathaway's cash position and how much they do genuinely have available to invest. So the way he looks at it is as a percentage of the business value of all the total assets that Berkshire Hathaway owns. And that percentage, even though it's about $140 or $150 billion, somewhere in that range, he views as only about 15% of the value of all the assets. So in terms of the generally accepted accounting principles, Berkshire Hathaway actually has the most assets of any company in the US. So they have a huge amount of assets in the business, and he really only views the cash as about 15% of that. So it's really not as big a percentage as perhaps the media may sometimes make you think. And he also said that they do have to have quite a significant amount of cash on hand to be sure that they have money available should any of the insurance businesses have large claims that they need to pay out and so on. So there is a floor to how low that cash position can get. But he said that basically Berkshire Hathaway, in his mind, has about somewhere between $50 and $75 billion that they could deploy into investments if the right opportunities came up. There was also some questions around share buybacks, and an interesting kind of quote that I got out of this from Warren Buffett is that they really didn't see any attractive stocks to buy for a long period of time, and really haven't made any major bets in the recent history in the last few months. And one of the things he then went on to say is we can't buy companies or stocks as cheap as we can buy our own, which is a really interesting thing to hear Buffett say. And that's kind of how he thinks about share buybacks. He doesn't just buy back his own stock kind of on autopilot like a lot of people do. They are price sensitive with their buybacks, and they also felt that it was the most attractive stock they could find at the time was their own. So that is a bit on share buybacks. Charlie Munger also actually went on to say that he'd bet on Berkshire Hathaway over the S&P 500. So this again is a question I've been getting for a while. Berkshire Hathaway has started to lag the S&P 500 over the past several years. Kind of depends what time frame you look at, but certainly it hasn't done as well as it has done in the past. And this was interesting. So Charlie Munger said, I'd bet on Berkshire over the S&P 500, and that assumes we're all dead. So in other words, regardless of present management or future management, he thinks that Berkshire Hathaway will do pretty well. And he thinks that on average, he's got better businesses in Berkshire Hathaway than the index or the S&P 500 does. So again, something kind of interesting to hear. And Warren Buffett actually said that he would bet on the index. So you kind of have two guys with both big holdings in Berkshire Hathaway on slightly different sides of the table with that kind of discussion of Berkshire versus the S&P. So there you go. There were also quite a few questions and comments around basically greenhouse gas emissions. So a couple of things on that around oil and gas. So Berkshire Hathaway has made some oil and gas investments, and they have a very, very large energy business within Berkshire Hathaway. And he basically said that he thinks people on the extremes of both ends of that argument, so the people that think, we have to stop using hydrocarbons and oil and gas kind of tomorrow or in the next couple of years, they think it's going to be phased out. And the people on the other end of the spectrum that think we can just use oil and gas forever. He said that people at both extremes are probably a little bit nuts. That's a quote from Warren Buffett. He thinks that, of course, eventually hydrocarbons and the use of oil and gas will be phased out over time, but he doesn't think that it's going to happen at a particularly rapid rate. He thinks that returns could still be good from oil and gas for a long period of time, and he thinks that the world is fairly reliant on them for the foreseeable future at least. So a little bit more on greenhouse gases. Greg Abel actually said something that surprised me quite a bit and I found super interesting and really impressive. And that's that Berkshire Hathaway Energy has achieved a 26 to 28% reduction in their greenhouse gas emissions compared to where they were in 2005. And that kind of lines up with the Paris Agreement, that they were actually the only utility company in the US that had committed to working towards that. And they've already gotten to that level in 2020, well ahead of when they actually have to be at that level. So that was super impressive. They've done a lot of work in trying to have more renewable energy over, again, traditional oil and gas and so on. They're trying to get to more sustainable ways of producing electricity, so pretty impressive for Berkshire Hathaway to be doing that. And there was actually a shareholder proposal in this year's proxy statement that basically was trying to get each of the subsidiaries for Berkshire Hathaway to file basically carbon emission reporting and have an overall Berkshire Hathaway company report on their current emissions and what they're kind of going to do in the future. Warren Buffett actually recommended his shareholders vote against that. And basically his reasoning there was that 90 to 95% of their emissions probably come from Berkshire Hathaway Energy. And, he doesn't think that there's any point in companies like Borsheim's or Dairy Queen or See's Candy, filling out all this excess paperwork and doing basically what he classed as kind of benign work. He gave the example of actually some financial statements that Berkshire Hathaway also doesn't do. So he thinks that they're probably one of the few very large companies in the S&P 500 that don't get a monthly income statement come to management. Warren Buffett basically says that that wouldn't really be of any use to him, month-to-month performance, so he doesn't request that from his managers. And it's just an example of some of the things that Berkshire Hathaway does to try and reduce headaches and admin in the way that they run their businesses, and they basically leave their subsidiaries to kind of run their own lives. Next up, we had a few comments from basically Warren Buffett and Charlie Munger on what I would class as just general market kind of craziness right now. So that is going to encompass very low interest rates. So Warren Buffett actually had like a little newspaper clipping which showed that very short-term bonds, so 4-week bonds, were actually trading at 0% interest rates from the Treasury in the US recently. So very low interest rates, very high valuations, so historically high stock market valuations, and also the rise of things like SPACs and Bitcoin, cryptocurrencies hitting all-time highs and all these sorts of things. So firstly, on just the valuation and interest rates side of it, Warren Buffett was actually a little bit less dismissive of very high valuations than I think he's probably been in the past. He said that if interest rates stay pinned at zero for forever, the stock market is extremely cheap right now. That's actually the way he worded it. So if you can get 0% interest rates from a bond, something like a stock that might produce much more than 0%, hopefully, actually suddenly looks far more attractive. And the real question that you have to be asking yourself when you value those businesses is, of course, you have to understand the future cash flows from the business and so on, but you actually also have to have an opinion on what you think interest rates might do out into the future. So if you think interest rates are going to stay pinned low forever, then stocks are really cheap. And if you think interest rates will come back up to some sort of normal level, then probably stocks are quite expensive at the moment. So that's sort of the way that he's thinking about it. The other thing he mentioned was some of the competition they now have for buying businesses. So this is something they've brought up more and more over the past couple of years. And the most recent example they actually gave was SPACs. So special purpose acquisition companies, we've seen several of them go public over the past year or so. And basically these are entities that are just purely set up as basically a pile of cash that has to go out and acquire some sort of business in a given time frame. So if they don't acquire a business within, say, 2 years, as an example, they have to basically wind up that SPAC and just distribute the cash back to the shareholders. So that's sort of the way that a SPAC works. And just with the incentive structures that are set up at many of these special purpose acquisition companies, really the managers and the sort of promoters of those SPACs basically have no downside. If they make a mistake, they really don't lose a lot of money themselves personally in most situations. There are certainly exceptions to that, but that's how it often works. But they really have access to a lot of the upside. So it means that basically these people that are in these SPACs and promoting SPACs are really out buying businesses at pretty hefty prices oftentimes, and it's just a lot more competition in general for Berkshire Hathaway to compete against when they're trying to buy businesses at reasonable prices or even really attractive prices. So Warren Buffett said if you told me I had to buy a business within the next 6 months, certainly he could do it, but whether that purchase would be a good idea or not is an entirely different question. So that was some comments on SPACs. Charlie Munger made a few more comments on cryptocurrency, and if you've watched Charlie Munger talk about cryptocurrency at all before, you'll probably know what he's about to say. And he basically said asking him about Bitcoin is like waving a red flag to a bull, and he's very much not a fan of Bitcoin. He actually went on to say that he thinks the whole development is disgusting, and that they've created financial assets out of thin air, which he's not a huge fan of. So Charlie Munger's probably got some of the more extreme views I've seen against cryptocurrency, and he kind of just reinforced that view in the Q&A session today. So I mentioned earlier that also on the panel for this annual meeting we had Ajit Jain. Now Ajit Jain is basically the head of insurance operations at Berkshire Hathaway, and he had a couple of really interesting comments from questions that he got asked obviously on insurance. So one of the first things he was asked about was basically about how the pandemic has informed how he's going to approach pricing insurance business moving forward. And he essentially said that, traditionally when they've priced risk, which was kind of what they're doing at an insurance company, they're trying to balance the potential risk and how much they may have to pay out in the event of a claim against what the likelihood of having to pay out is, and therefore what price they must have to charge for that insurance in order for the deal to make sense. It's in a lot of ways it's kind of a probability assessment, just like investing in companies often is. So Ajit basically said that pandemic risk was always priced into some of these insurance policies. It has been for a long period of time, but they had probably underestimated the likelihood of pandemics and also underestimated the likelihood of how that impacts different events. So for example, they insured actually the Olympics, and they had some broadcasting and TV companies that actually had insurance with Berkshire Hathaway, so that if things like the Olympics got postponed or cancelled, Berkshire would pay out to those broadcasting companies in order to cover the sort of lost revenue that they were hoping to get from the Olympics. So really they hadn't priced in things like event cancellations as part of their approach to pricing in a pandemic into some of these things. So Ajit Jain basically went on to say that they've sort of recalibrated some of their pricing in order to factor in these types of learnings moving forward. But on the flip side, some of Berkshire Hathaway's businesses in the insurance field have actually had quite significant tailwinds, and Geico is a good example of that. So Geico, obviously being a large insurer of autos, or of cars, has actually had massive tailwinds because people have just been driving less. They've been working from home, not driving to work, and really just not traveling as much in general, and that has meant a whole lot less claims, for Geico to pay out on. So that's actually been quite a significant tailwind for the insurance arm of Berkshire Hathaway as well. Ajit actually got an interesting kind of theoretical question about whether he would insure Elon Musk going to colonize Mars, and whether he would insure the Falcon Heavy, and how that insurance premium pricing may change whether Elon Musk was on the flight or not. He basically said that one would be an easy pass. It just goes in the too hard basket and he wouldn't know how to price it. So that was kind of an interesting question for him to get as well. Next up, Warren Buffett actually spoke quite openly about some of his stock holdings. Now, Warren Buffett is not typically one to kind of get into the nitty-gritty of why he's invested in certain companies and why he's not, but he actually was willing to talk about some of the bank stocks. So in recent 13F filings for Berkshire Hathaway, we've seen that they've sold down a lot of their investments in the large banks over in the US, but we've also seen that they've held or even added to one particular bank, that being Bank of America. And Buffett basically said that he really likes bank investments. He really likes those businesses, but it was getting to a size in the portfolio to where Buffett wasn't necessarily comfortable with the amount of exposure that he had to that industry. So he chose to basically shrink that exposure to banking by selling some of the bank holdings that he had, and he essentially has concentrated it in what I kind of interpreted, reading between the lines here, as sort of his favorite bank, that being Bank of America. So interesting to hear that bit of commentary on the particular bank holdings for Berkshire as well. Now, two final sort of questions and topics I want to cover. The first one is about Robinhood. Now, Robinhood did come up a couple of times, and I guess this kind of flows on from some of the opening remarks that Warren Buffett made about a lot of new investors kind of coming into the stock market. And Charlie Munger and Warren Buffett had some not so nice things to say actually about Robinhood, and Charlie Munger has kind of had similar comments in his daily journal meeting from a month or a couple of months ago. So Warren Buffett said he's actually really looking forward to reading the S1 filing that Robinhood made. So the S1 filing is basically what a company has to file when they go public, when they IPO. And he's kind of interested to hear how they describe how they make money. So Robinhood, of course, does not charge brokerage fees on their stock trading, but they do sell things like order flow, and they, as Charlie Munger has argued, potentially actually have more expensive brokerage than the people that just charge fees. So Charlie Munger and Warren Buffett are really interested to kind of see how they actually just describe that, how they actually describe their business and how they make money. And Buffett also made a comment that there's a lot of gambling going on by Robinhood users. He looked at simply things like the volume of options that were being traded in very short-term contracts. So he was looking at Apple as an example with options contracts that expired in 7 days. And these are really just people gambling and betting on whether the stock price will be higher or lower in the very, very short term. And Munger made similar comments, but he put it a little bit more bluntly than Warren Buffett did. And this is a quote from Charlie Munger. He said, "It's god-awful that it attracts investment from civilized people, and we don't want to make money from doing things that are bad for society." So that was a comment pretty much around Robinhood, and he also sort of put it in the context of lottery investments and things as well, and lottery companies. But kind of continues the theme of these sorts of comments from Charlie Munger in particular, but now also Warren Buffett, on the gambling and the speculation that's come into the stock market in recent years. Okay, and one final question which I found super interesting, and this was actually to do with inflation. So Charlie Munger and Warren Buffett are not known for getting particularly kind of macroeconomic when they do their investing, but nonetheless they do collect a lot of this type of information just through the businesses that they do already own. And they got asked about inflation, whether they're seeing any inflation within the businesses at Berkshire, and the short answer to that was yes, and they're seeing actually very substantial inflation in raw materials. So in particular, things like steel and lumber. Steel was probably the main one they mentioned, though, with raw material sort of price inflation. They said people are willing to pay much higher prices for raw materials. They've put their prices up for the products that they sell after using those raw materials, and people are happy to pay those higher prices as well. It's genuine inflation that they're seeing within those businesses. And frankly, it's been a lot more inflation in that area than a lot of people really expected. He said many of those businesses for Berkshire are red hot. The economy simply is performing really, really well. And that's flowing through to the price of raw materials and the price of pretty much everything that's going on in their business right now. So there you have it. That is my summary of the 2021 Berkshire Hathaway annual meeting. Pretty early start for me to watch this live, but really enjoyed it, and I hope that was a useful summary for anyone that doesn't want to sit through the 4-hour long kind of Q&A session for Berkshire Hathaway. So I hope you enjoyed. If you did, please hit like and hit subscribe. Would love to hear any of your highlights from the meeting down below if you did watch it as well. But that's it from me today, and I will see you in the next one. Cheers.